We're half hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Stephen Engle with Annabelle Droulers.
Our top stories. Asian stocks trading cautiously after post-election Trump trades push Wall Street higher. The dollar hitting a fresh one-year high in Bitcoin, briefly topping $89,000. The US president-elect moving quickly to install loyalists into prominent positions in his administration as Republicans edge closer to a House majority. And fresh signs of pressure on the Chinese economy with credit expansion slowing more than expected in October. Yesterday in the markets, we spoke about those two themes coursing through. On the one hand, you've got those Trump trades. They're continuing to take hold. On the other hand, you've still got that caution really reigning supreme around China. And that is what is continuing to dictate market sentiment here in Asia. You've got the broader Asian benchmark down for a second straight session this week. And again, you've got US futures fairly flat right now as well. But to note, we did see the S&P 500 notching its 51st record of the year overnight. Again, coming back to that China story, we had the MPC meeting on Friday, that presser spelling out these plans around the debt swap program for local governments. That very much underwhelmed a lot of investors. Inflation data over the weekend that showed that really a stimulus is yet to take hold. And then aggregate financing figures came out overnight. And here we saw in the data that the credit expansion slowed more than expected last month. And we're seeing particularly weak demand for loans coming through from corporates and also from households. How that's been expressed so far in all of these proxy assets. Oil has certainly been one to track, and you're seeing Brent crude just coming online, fractionally higher so far, but still keeping it in perspective. We saw it sinking nearly 3% in the prior session, and again, it's that softer outlook for demand from China that's really playing into the theme. Let's switch on and take a look, as we said, those Trump trades, really the key focus on Wall Street. And here, again, expressed in a different way. But it's really that focus on deregulation, in particular the banks index. We've continued to see that gauge moving higher. Tesla, of course, Elon Musk, one of the key beneficiaries, someone who invested personally a lot into their campaign. Now it's that question, what does he get out? Bitcoin, still that major theme around not exactly deregulation. We want the rules to come in place, maybe pro-business, but we definitely want the regulatory landscape spelt out. And that's why we've seen Bitcoin, as we said, briefly topping $89,000 gauge as well, hitting a record. There we go. There we see the outlook for China today. And again, Steve, it's that same story. We're still seeing weakness in the Chinese markets. And a lot of people have been talking, we're pretty much range bound from here. Yep. What's going to be the next thing that moves the needle in either direction? Yeah, absolutely. I spent the whole entire week in Shanghai last week, and there was disappointment at the lack of extra fiscal stimulus coming from the National People's Congress Standing Committee, and that's where the kind of markets are languishing right now. We'll be watching the Hang Seng again today. It has been down, Annabelle, about 11.7% since that first batch of stimulus high on October 7th. As I said, down more than 11%. So we'll be watching Hang Seng losses, whether they can stem those. There's been some positive news coming out of Hong Kong, though. Financial jobs are on the increase, and we'll talk about that throughout the morning. Baidu World, we're going to get Robin Lee speaking there. He's perhaps going to reveal some more AI details, AI investments. No doubt all these big platforms in China moving into the AI space. Annabelle just talked about the crypto stocks. Obviously, crypto or Bitcoin soaring as high as 88,000. Earnings, again, we keep this cavalcade going. Tencent Music and also Macau's SJM reporting, among others. And then we get FDA data out of China. Busy day. Yeah, and on the data front as well, as we said, that story around what we saw in the credit numbers slowing more than expected in October, and suggesting, as we said, that stimulus rollout hasn't really translated into stronger demand for borrowing just yet. But let's get more with our China correspondent, Min Min Lo, joining us. And Min Min, again, just talk us through the data, what it's telling us, and the demand particularly from households and from businesses.
Yeah, so the October total aggregate financing came in at 1.4 trillion yuan. That is below analyst estimates of 1.5 trillion yuan and also below last month's print of 1.8 trillion yuan. And bear in mind that the bulk of this borrowing, more than 3/4 of it, is because of government debt, government bond bond sales, and that means corporate and household borrowing is still quite lackluster. And granted, yes, October is typically a month where we don't get a big number because banks are not in a rush to lend. But still, if you compare to the past 5 years average, corporates and household borrowings, that's still way below that average number, which shows that the stimulus hasn't really taken effect in terms of boosting that confidence in the economy.
And Min, we're going to get the FDI and also the trade surplus approaching a record high, of course. I did talk to Pascal Lamy over the weekend. He said that shows weakness in China, obviously, because of that imbalance, not enough consumption and just relying too much on exports. Yeah, it's a strength and it's a weakness, it's a vulnerability as well in terms of this, trade tariffs that are targeted at China. So China's trade surplus is on set to hit about 1 trillion yuan this year if it continues to grow at the same pace that it has been all year. So year to date so far, the first 10 months of the year, it's come up to about $780 billion. That's the highest on record for this period so far. And not surprising, the biggest trade surplus is with the US that has grown by 4.4% this year. But what's surprising is the biggest increase is with the ASEAN countries that's increased by close to 36%. So what does that tell you? Either the exporters are diversifying their destinations or they are using these ASEAN countries as intermediaries while the exports find a way to get to the West. So that's a possibility as well. And on the flip side, you have import demand being very weak because of the weak domestic demand and also this replacement of foreign manufactured goods with domestically produced ones. So that's what's happening. And it's possible it could, spark a currency war because India is saying they're willing to let the rupee devalue if China devalues the yuan in response to the US tariffs. All right, Min Lo, thanks so much for joining us, Bloomberg correspondent. Min, let's bring in Zongyuan Zoe Liu. She's a senior fellow at the Council of Foreign Relations. Zoe, thanks for joining us. Our correspondent was just talking about some of the challenges in the domestic economy in China. Would you say the most pressing demand right now is, the pressing challenge is boosting domestic demand?
Thank you very much for having me. And indeed, I agree with the analysis that the current most challenging and perhaps most pressing challenge is to boost household confidence in the Chinese economy, not just because of income growth has been slowing down in the past 5 years or so, but it also because of people's confidence about the prospect of their accumulation of wealth as well as their household income growth in the coming years can continue be at least on par with the previous 5 years.
So again, Zoe, we were disappointed in the market about stimulus, fiscal stimulus coming out of the Standing Committee of the National People's Congress. Is this justified that investors are hanging on more sweeteners from the government, or is it justified that they are actually kind of waiting to see how the whole Trump plays out?
I think the investors, or for that matter, broadly speaking, market expectation of a bigger fiscal bazooka is rational because that's how especially if market expectation of the Chinese economic growth slowdown is more cyclical rather than structural, right? That is rational expectation. But the challenge here is that the Chinese economic slowdown is a convergence of both cyclical and perhaps structural that the difficulty has been exacerbated by a lot of geopolitical uncertainties, not just because of the U.S. election cycle. So from that point of view, I would argue that regardless of the election outcome, the need for a fiscal bazooka, especially targeting at the consumer confidence at the household level, is particularly important. But there are again, structural constraints that why the central government perhaps is reluctant to do that. And a big, perhaps, challenge of that is, indeed, the housing market and the local government debt. But then on the other hand, there is also the need or the party's commitment towards self-sufficiency.
As you say, I mean, it's really that question around how they handle that long-term structural issue of industrial overcapacity. I'm interested in your view on on where China can look to send these exports? Because there's been that growing relationship that we see between China and various countries in the global south. Is that enough to sort of absorb this? Or do you think if we actually do get some measures that are targeted specifically at increasing consumption in China, is that enough to bring the economy back into balance?
That is indeed a good point. And we have seen the Chinese, Beijing has been taking concrete steps trying to boost the domestic consumption by these trade-in programs, encouraging Chinese household or Chinese companies or industrials trying to sort of trade in the old facilities or machines, trying to get new ones. But that probably is not necessarily going to be enough. Part of the reason is because, the export market growth prospect is not necessarily going to grow as fast as before, if not completely shrinking. It's not just because of the prospect of tariff from the United States or from the European Union, but you also see a wave of protectionism in emerging market economies. And a part of the reason from there is because a lot of these emerging market economies, they also wanted to build up their own industrial base, right? So, there is the challenge there. But then on the other hand, China, the reality is that China's market share in terms of manufacturing as a percentage of the globe is about 30%. And that sheer number speaks to the reality that China cannot detach itself from global market. So given that domestic fears, price wars, it means, very thin profit margin. So there is corporate incentive to go out and invest overseas. Perhaps that is going to be the strategy going forward, meaning Chinese companies wanting to find more tariff transit countries that can mitigate the impact of tariffs.
But that focus and that reliance on exports, it can become a sort of Achilles heel for China then. How should countries, and specifically the US administration, think about crafting its foreign policy toward Beijing in light of some of those vulnerabilities?
Right. That is that perhaps is the one of those policy priorities of the Trump administration. Right now, I think China has been learning from or trying to learn from the lessons of Japan in the 80s, and I think there perhaps is, given that President-elect Trump is probably going to be in the White House in January next year, and given that he is very much focusing on deal making, the degree of or the likelihood of a U.S.-China trade deal with the prospect of China agreeing to a voluntary export restriction, taking a page from Japan in the 80s, that likelihood is probably going to be higher than before.
All right, that was Zongyuan Zoe Liu, the Senior Fellow at Council on Foreign Relations. Thanks very much for joining us. And great report that was titled, Why China Won't Give Up on a Failing Economic Model. But we're certainly going to have more details on those stimulus measures ahead. CSOP Asset Management is going to be joining us, talking about investor sentiment. As we said, Beijing really laying out these steps now to try and stimulate the economy.
Well, but first, Donald Trump's new cabinet slowly taking shape as he prepares for his return to the White House. We take a look at the president-elect's picks coming up next. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is, of course, you know what you're watching. You're watching The China Show.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Less than 15 minutes away from the start of trade for mainland markets this morning. We're just getting the yuan reference rate coming through pretty much in line with estimates here, but put it in the context of how the yuan, both the onshore, offshore, has been trading, sitting around a 3-month low against the greenback that overnight managed to hit a fresh year-to-date high. In addition to those moves that we're seeing in the currency space, it's that focus on what's coming through in the economy, because we just had the credit figures out overnight. Again, we saw aggregate financing telling us that households and corporates, they just do not want to borrow. And it's yet another expression we see of weakness in the mainland economy. Stocks-wise, again, we're pointing to some further losses here today. And that is likewise the story we're seeing in Chinese equities trading sideways. The momentum, is it starting to give up? And the stimulus measures that continue to disappoint.
Confidence is a tough commodity to get and keep and hold on to, right? So Republicans, speaking of confidence, they're on the brink of clinching unified control over the White House and Congress under the president-elect Donald Trump. And that man, Mr. Trump, is narrowing the field of candidates for major appointments such as Treasury Secretary, which could be announced this week. Bloomberg News desk editor Jill Deesis is with us now. I'm fascinated by the quick pace of getting these, appointments named, at least out there. But a lot of them are from the House. Is this an interesting dilemma that he might be creating for himself when the election really is already showing such a thin possible majority for House Republicans?
So as we know, the House of Representatives, the majority has not yet been decided. I think at this point, you need 218 seats to control the House. Republicans have 214, so more than the Democrats right now. Democrats are currently up in some of the outstanding, I think, 17 or so races that are still yet to be decided. Republicans are ultimately at this point favored to take that. But yes, I think when you start to look at some of these picks that Donald Trump has come up with, he's got New York Congresswoman Elise Stefanik, who's picked for the UN position or considering there. You also have Mike Wallace, the Florida congressman that he's picked to be his national security advisor. We're hearing. I mean, these are people that, at this point, the House Republican, the majority speaker, Mike Johnson, is kind of like, sitting there saying, like, okay, well, wait a minute, like, are we going to have, some of these positions in place? I mean, ultimately, this might be a bit of a non-issue, depending on how some of these races decide, but it is kind of interesting. I mean, you had Elon Musk just say the other day, he saw that Elise Stefanik pick, saying, like, wait a minute, we might still need her in the House. So, yeah, kind of an interesting dynamic there unfolding as we start to see some of these positions really get locked up.
Any surprises among those names? And I know it's an Afghan veteran as the national security advisor. The Treasury pick is coming imminently. A number of names have been bandied about. What's been a surprise so far?
Yeah, I mean, actually, a lot of this does kind of feel a bit in line with what you'd ultimately expect from Trump. So if you remember, his first administration was actually full of, quite a few more establishment Republican figures. I'm not sure if that was sort of a need for somebody that was a political outsider like Trump to kind of come in and appoint people that were well known and in line with that establishment. But what we're really seeing in a second Trump administration as he's kind of preparing for this is he's much more interested in hardliners, loyalists, people like Stefanik. You also have Stephen Miller, who was the architect of his travel ban during the first Trump administration, kind of coming in a pretty key position here. So it does seem like what Trump is much more interested this time around is working with those loyalists and not necessarily people that might counter him in the White House.
And actually, just one of the loyalists that is coming out now is we have New York Times reporting that Marco Rubio could be named as Secretary of State. He is someone who has been very loyal, as you said, to Trump, even after he was passed over as being that vice presidential pick. But he's also someone who's been very hawkish on China in particular. What does that tell you about how that relationship between Washington and Beijing could unfold? And given this is breaking news, maybe you don't have all the context, but is there any concern that when you surround yourself with so many yes men, you don't get enough balance of opinions as well?
Yeah, I mean, like, that's ultimately like the major risk here, right? And I mean, we've seen that play out in other countries, and particularly with more autocratic leanings and such. If you're surrounding yourself with loyalists all the time, I do think that a pick like Marco Rubio does kind of signal this tough on China approach that Trump has obviously been signaling here. I mean, we had that 60% tariff on Chinese imports claim were promised during his candidacy that may be coming to the fore here. I mean, the complication situation with China, or at least I think kind of the interesting thing with China, to me, remains whether the Elon Musk question mark kind of comes into the equation here. The fact that Elon Musk, this very dedicated Trump supporter, obviously contributed massively to the campaign and is expected to play some kind of role in the White House, whether that be formal or informal, obviously has incredibly tight business ties in China via Tesla and other ventures. So, I mean, you've really got that, I think, kind of like that looming, outstanding issue here. But yes, I mean, obviously, Trump has, really projected this idea of being, that tough guy on foreign policy. When he comes into the White House, picks like this just kind of reaffirm that.
I definitely think that's going to be one of the most interesting things to watch. What happens with Elon Musk, very close position in the White House, very big business stake in China as well. So certainly something that's going to be closely tracked in this part of the world. But that was our Bloomberg News Desk editor, Jill Desis. And look, of course, at how China's futures are looking. We're just under 10 minutes now from the open and certainly guiding to a weaker start here again. Geopolitical risk is just another headwind facing these markets. But more ahead, this is Bloomberg. Pretty much bang on 5 minutes until the mainland markets open today, and it's looking for another day of in the red, basically. I mean, we just had more data coming out overnight. Credit figures, disappointing investors, follows on what we had with the inflation figures. The debt swap plan for local governments in China, that disappointed. And then you can add the geopolitical risk as another problem. Yes, well, you look at the foreign direct investment numbers, they are back turning downwards a little bit. They've lost a little bit of steam with on the back of the stimulus. The second quarter was really bad, obviously, for foreign direct investment into China. So there's a lot of uncertainty, obviously, as money is a bit hesitant to go into this recovery story in China. And you've got, of course, Trump possibly naming Marco Rubio as the Secretary of State. I mean, Marco Rubio has a webpage basically dedicated to his charge against China. He claims to be one of the leading and one of the first to bring up some of the, ring the alarm bells on China, whether it's the Confucius Institutes in the United States, also what's happening in Xinjiang, protecting advanced technology. I mean, the whole website talking as well about, allegations of the Wuhan Institute of Virology leading to the, obviously the pandemic. He has made a lot of claims against China and refers to China consistently as communist China. He makes that point consistently. Yeah, hawkish on China, but certainly going to be something to track, of course, as we get these appointments possibly being confirmed. But stocks to watch as well. It's really that Trump trade in focus because we've seen that big move higher in Bitcoin, touching 89,000. Crypto stocks, of course, we're keeping an eye on those. We did see them gaining in the session yesterday. Today, looking like we're going to see here for the pre-market more weakness ahead. Gold miners, of course, another thing to be tracking here because we've seen gold actually nearing a one-month low against the greenback. We did see the dollar gauge hitting a year-to-date high. But again, gold stocks ones to track, and we are seeing them weaker here. Geopolitical risk, again, it plays into that, but probably it plays into many, many sectors, Steve. Yeah, absolutely. 2,620 on gold spot right now. Heading towards 3,000, maybe. We'll be right back. This is Bloomberg. And welcome back. You are watching the China Show. We're counting down to the open of markets. China and Hong Kong set to open. That's right. Yeah, we've got you've seen the offshore yuan there a little bit weaker against the greenback. We just had that fix coming through pretty much in line with estimates here, but we do see the offshore yuan and the onshore as well trading around a 3-month low against the dollar here as we saw it hitting that high overnight. It's really that twin theme that we're seeing here. On the one hand, you've got these Trump trades, that euphoria continues to take hold, being expressed in things like Chinese or rather US equities, banks in particular, Tesla, Bitcoin. On the other hand, you have that weakness around the Chinese economy. Not only did we just have the aggregate financing data coming out overnight, we also are seeing FDI. That is really pulling back in the mainland. But let's take a look at how these markets are coming online this morning. The CSI 300 here, fairly flat so far, but that is also the direction that we're seeing for equities that is developing here. Really, we've seen that rise, that stimulus-linked rally halting somewhat, losing momentum, and the question is really how investors start to pass over that and whether that stimulus starts to take hold. Certainly we didn't see it in the aggregate financing data. We did not see it in the inflation data over the weekend, and you can add to that as well that debt swap plan for local governments that underwhelmed. What could really set the tone, though, for markets is what happens with earnings, and we've got a couple of key ones on the docket this week, particularly in the tech space. If you change on now, take a look what's happening in Hong Kong, but these are some of the names that are going to be reporting their numbers. You've got the likes of Alibaba, Meituan as well later this week, Tencent as well, one to be tracking here. This hour as well, we're going to be speaking or hearing from the Baidu CEO, Robin Li. He's speaking at a Baidu event, essentially, where they could be rolling out AI hardware. That could be a way to sort of play that game, monetize in the space. But the Hang Seng here, you see under pressure, 0.6% in the red. Hang Seng Tech is what one to be watching quite closely. That's the state of play there. Of course, Hong Kong is continuing to try and attract more companies to this market. We did actually see some progress for Oasis. That's the government agency that's really tasked with bringing these companies to the city. Change on now. iFlyTech, for instance, is one that's teaming up with Baidu in the city. They're going to be moving some operations here. Both of those stocks in the red so far. Again, earnings, as we said, to note. Tencent Music is one that's coming out later. Mention those Trump trades. Certainly it's still continuing to play into crypto in particular. We've seen Bitcoin, for instance, touching 89,000. We are continuing to track these crypto-linked names. Again, look at those gains you're seeing for OSL there, one of the listed exchanges in the city. It has been quite an incredible rally for some of these names. As we said, US exceptionalism, that story seems very much intact. It is at the expense, possibly, of Chinese equities. And when you take a look at what's happening in the ETF space, Steve, it's really that story of outflows. We've got this terminal chart here that really puts it further into perspective. But again, from the US perspective, we are continuing to see that money moving out of mainland-linked ETFs back into the US. We can show that chart perhaps when we bring in Ding Chen here. She's CEO of CSOP Asset Management, joining us this morning in studio. And Ding, I'm curious, how are you seeing this playing out? Because we're seeing this chart here. We're seeing some of the ETFs have got record outflows following Trump's win. You've also got to say maybe it's a story around China's economy. Is that what you're seeing for your products?
Thanks to have me here today. So from our product perspective, we see continually inflow during this period of time of our China A ETF and also a Hang Seng Tech ETF. And because of, as you know, obviously the government's stimulus plan and the China investment theme coming back since the late September. So we see continually, inflows.
So you believe, though, that the promise or the prospect of more stimulus is what's attracting those investments still? There's not the fatigue that we didn't get what we wanted last Friday.
Yeah, Stephen, you said there's some disappointment in the market. People are expecting more bigger size of the stimulus plans and also direct stimulus like property, buyback programs, and also the big banks recapitalizations, direct consumption stimulus. But we only see the debt swap program comes out, and also the scale is a little bit bigger than everybody expected before. But still, I think for the stimulus plan, it's from the Beijing point of view, probably they are thinking it's like a step by step. So still we see, yesterday the market, and also Friday's market, some of the major index are performing fairly well. Although some people are quite disappointed about the package.
Right.
Yeah.
Can you characterize these confident investors for us? Because if you take a look at sort of overall liquidity in Hong Kong, around half of it is southbound flows. Can you characterize the investor in these ETFs?
Yeah. So from our ETF, we cannot categorize a different investor very, very clearly, precisely. But we do see, investors from, mainland China, and also from outside of mainland China, regional investors coming to our ETF quite a lot recently. Give you an example is like, before, obviously, September 24th is a very important date. Before that, a lot of people coming here talk about, China's non-investable market, right? At that moment. But since the September 24th, the PBOC's, the governor of PBOC and the chairman of CSRC, Wu Qin, talk about, people say it's equivalent of the whatever it takes, the moment. And the whole sentiment changed quite dramatically. And we see, not only from mainland Chinese investors, but also regional investors rushing to the market. Yeah. The reason is because, first of all, you said liquidity. So I think liquidity is a very important role in the capital markets. You can see since September, the market obviously rallied quite a lot. Give you an example, like CSI 300 rallied about 22% until last Friday, and some, other index like Star A50 in mainland China rallied more than 50%. And in Hong Kong, the Hang Seng Tech, we have a 3033 track that index, rallied more than 22%. So obviously, those performance can attract a lot of investors' attention, right? But also, I think the more important thing is the liquidity, the improved liquidity. So that shows, the liquidity can play a very crucial role to serve the institutional investors.
Well, on that note, then how significant are these links that are being developed with a couple of ETFs tracking Hong Kong and Chinese stocks in Saudi Arabia? I'll be speaking with Paul Chan tomorrow, the financial secretary of Hong Kong. I'm sure he's going to be talking about the diversification of Hong Kong to places like Saudi Arabia, not be so reliant just on the United States, the West, and even China.
Yeah, I think probably Paul will talk more. But from my perspective, I think certainly to go to Saudi to promote Hong Kong market in that area it definitely worth it. So last week, not last week, probably 2 weeks ago, and we launched our Hong Kong first ETF on Tadawul, which is the Saudi stock markets, and we are very luckily. We list that ETF during the FII, which is their main forum of Saudi. Apparently, all the big celebrities in these financial sectors all been there. So this is a very, very big thing for Saudi and also for Hong Kong. And that ETF currently right now is the largest ETF in Middle East. And also since that ETF launched, 9410 launched, the ticker is 9410 launched in there. And pretty much, every day, the most traded ETF is that one. So you can sense, people are interested in Hong Kong. People are interested in China. And those areas, when we do roadshows over there, we find out, people knows not that much about China, but they have be curious about the market, and also they know the economic miracles, and also because Saudi is trying to do their own economic reform. So we listed this product like less than 2 weeks. We see significant inflows, mainly from retail to the fund. Right now we see roughly about 14 million Hong Kong dollars inflow, from the local investors to that fund. So I think it's a good thing to start.
All right, Ding, stay with us. That's Ding Chen there, CEO of CSOP Asset Management. We'll have more ahead with you, but taking some live pictures now as well, because we've got the Baidu CEO, Robin Li, just taking to the stage at Baidu World 2024. This is really going to be an event. Perhaps we actually could see a bit of a special AI hardware feature that comes out at this. AI glasses are tipped to be one of the new products that are being brought to the market just in the next couple of hours. But certainly we have seen Baidu amongst a lot of the Chinese internet players sort of struggling to monetize their AI because a lot of Chinese consumers aren't really willing to pay for those services just yet. Right. So that's going to be something to watch at this event today.
I want to see those new AI-powered glasses as a rival, really, to Meta Ray-Bans. See how cool they look. You remember the early products in this category were not that cool. They weren't that...
Kind of fell flat,
a little
you could
dorky,
say.
a little invasive when someone comes up to you with these camera, loaded glasses. But let's see if Robin Lee has something a little bit better up his sleeve or on his nose.
That's right. We'll have more ahead. This is Bloomberg. Taking a look at Bitcoin prices so far, I mean, it's just that continual tear that we're seeing over 3 days alone, up 16%. It really just tells you, I mean, is it FOMO as well? It's probably not just a story of the Trump trade, but certainly we're seeing that expectation, maybe $100,000 for a Bitcoin token. It certainly seems to be coming into sight. It's the prospect, of course, of regulation coming into the space. Donald Trump is someone who's vowed to essentially boot SEC Chair Gary Gensler from the position on day one, install someone who's a little bit more friendly to the industry. But let's get more on this now. Bring back Ding Chen. She's CEO of CSOP Asset Management. And Ding, of course, you didn't launch a Bitcoin tracker ETF, but you do have an inverse product in Hong Kong that was even launched ahead of those. How have you seen demand for that, given the rally that we're seeing in crypto prices?
Yeah, Anna, we don't have the spot Bitcoin ETF. We do have like future-based ETF track the ETF price. We launched that ETF 2 years ago, and with that one, obviously the demand is quite high. And you mentioned the inverse one. We see, because the rallies goes up for the past 3 days, like 16% rallies. So we do see, some people are more interested in inverse as well. We get a lot of calls from the investors about that specific products. So for the inverse one, people is like, typically, they will, as long as one asset class goes up too soon, too fast, they will look at the inverse. They will see some corrections will come down. It will come, and then they will place in some positions on that one. Yeah.
What about for other products? Would you be looking at doing the same for Ether, for instance?
The Ether one, yeah, that's a good question. So still, I think, at this stage, probably we'll focus on Bitcoin, future-based beta Bitcoin and also the inverse Bitcoin, yeah.
Beyond Bitcoin and Ether, of course, they're the two major and most heavily traded tokens, but we have seen a lot of trading activity around Solana, for instance, that could be, again, a key beneficiary or key winner under Trump. Are you looking at announcing or releasing other products for other crypto tokens?
Currently, we are still, focused on Bitcoin and Ether. And from other, virtual asset related products or things, we are, put our eyes on like tokenized funds, tokenized or mutual funds or ETFs, and try to capture that from that way. Yeah.
The tokenization trade. Let's shift back, because it's not just, of course, the focus around digital assets. We have seen tech, sort of varied fortunes, but Tesla, of course, one of the big beneficiaries so far in these Trump trades. You just launched a Mag 7 ETF last week. How has that been performing so far, again, in light of that U.S. exceptionalism story?
Oh, yeah. So last week, we launched this Mag 7 ETF during the election days. Obviously, we're very lucky, we pick up a good day to launch this Mag 7 ETF. A lot of people look at that, and we got a lot of tens of requests about that. And a lot of people, even in mainland China, calls us to say how I can buy these products. Say, okay, unfortunately, it's listed on Hong Kong Stock Exchange. You cannot buy that. Currently, I would see the investments sentiments are very good. From our main seeders, they already sell all their seeding positions. We probably will see creation very, very soon for these products. Yeah.
All right, that's Ding Cheng. Thanks so much for joining us for over 2 sessions here on The China Show. We'll have you back very soon. Thank you very much. Ding Cheng, CEO of CSOP Asset Management. We have breaking news. This is more stimulus, Annabelle, in a sense, in cutting taxes. China plans to slash home buying taxes to boost the property sector. Let's get more on that from Min Lo, our China correspondent. I've been reading through the initial headlines. This would essentially cut the deed tax in places like Shanghai and in Beijing to as low as 1%. What are we hearing?
Yeah, so regulators are working on this proposal, as you said, to allow the mega cities like Beijing and Shanghai to cut the deed taxes from as high as 3% to as low as 1%. And on top of that, they are looking to scrap the distinction between ordinary and non-ordinary homes. Now, non-ordinary homes are, you can understand them as luxury homes above a certain size. So in Shanghai, it's above 144 square meters. Yeah. And how it works now is on top of the deed tax, you still have to pay quite a steep value-added tax of up to 5.6%, for instance, on these non-ordinary homes if you sell them within 2 years.
But are they cutting that? That's a big tax, 5.6. Non-ordinary meaning luxury, basically.
Yes.
So are they removing the distinction between luxury and ordinary?
Exactly. They're removing that distinction. So what that means is it will make it easier for people to upgrade their homes. It will make it cheaper for them to do that. And I guess this is another sign of intention from the government to stop that decline in the housing market, because the last 2 months had been a series of measures that were being rolled out, including the lowering of down payment ratios, the existing home mortgage rates, for instance, and easing home buying curbs in the big cities as well.
As you said, Steve, really, and Min, another signal that we're getting some fiscal support coming through. That was our China correspondent, Min Lo, there, and we have really seen that market reaction so far because property stocks are really moving higher off the back of that announcement. We'll have more ahead. This is Bloomberg.
And welcome back to the China Show here on Bloomberg. Of course, we have this breaking news. Still, the markets are digesting it right now. There's the BI China Developers Index, still a little bit down. Maybe we should bring up as well the Hang Seng Property Index, the HSP, to see how that's responding as well as the broader market, the Hang Seng. China, according to people familiar with the matter, is planning to cut taxes for home purchases as the government is dialing up its fiscal support to revive the housing sector, which, of course, has been a real drag on growth. They're working on this proposal to allow megacities like Beijing and Shanghai to cut the deed tax for buyers to as low as 1%. Right now, it's as high as 3%. There's also, this is something essentially, Annabelle, that the finance minister, Mr. Lan, had, hinted at last week. More steps. Again, we're going to be step-by-step approach to this fiscal support of the market. But they could also, under this latest proposal, according to sources, remove the designation that the larger cities have, and that they'll have the ability to remove the designation of non-ordinary and ordinary homes, meaning luxury or non-luxury homes, because there's a large value-added tax for so-called non-ordinary homes, which are luxury properties that supposedly only the rich can purchase. That tax, VAT, is as high as 5.6%. So if they're able to lower that, that could incur buying and interest.
Yeah, exactly. If it's easier to upgrade your home, if it's less expensive to do so, it might finally stir some more interest in the property market. But Shanghai, for instance, apartments that are bigger than 144 square meters, that's around 1,500 square feet, they're ones that are considered non-ordinary. But certainly we are seeing, as we said, that market reaction. Hong Kong, though, of course, there's the other focus, appearing to be recovering from a bruising brain drain that's really been affecting the city, of course, following COVID years, also the political unrest. But we've got wealth management really could become a hub for it. So let's bring in our global business reporter, Jin Shan Hong, joining us here, and tell us, because there has been a jump in licensee numbers, who's behind those and what kind of positions are we talking about here?
Yeah, so we look into regulation and license records by SFC in Hong Kong, and after collecting 500,000 of records, we do see this talent drain in the past 2.5 years. But when you reach a trough in June, we see this rebound for a straight 4 months so far, adding more than 800 licensed individuals into this database. So this increase recently are increasingly seen in the sectors such as advising on securities as well as asset management. And the leading representative in both of these categories, each of these categories, are CITIC Securities for securities and hedge fund Millennium for the asset management. So in October, SFC also launched a new category of license for supervising on the public funds, which is also a key building block for the city's march towards building the world's biggest wealth hub.
So this is not just talk anymore. This is actually happening? I mean, and how much momentum does this give Hong Kong to say we're back?
Yeah, so at this point, according to analysts in the market, it seems like with the increasing geopolitical risks, we are having this need in the city to have wealth managers as well as relationship managers helping high net worth individuals to navigate market uncertainties. And then at the same time, when we scroll down the newly added list, we also see an increase in hedge fund managers and private equity managers as well as family offices here setting up in the city. So with all these changes, the increase has only been 4 months, so there could be short-term volatilities influencing the employment market. But as we are now in the moment setting up for the companies into the first quarter next year, we might see more certain trends showing up there.
Okay.
Right, that's our global business reporter there, Jin Shan Hong, with the story. And now for a quick check on markets as well. We've just seen the CSI 300 actually erasing some earlier losses here, now trading up nearly 1% higher. There has been a story coming through that we're hearing from sources that Beijing is planning to slash home buying taxes, that's across the nation, but to try and boost that property sector. And we have seen some of those property or real estate developers rising in tandem. But you're watching The China Show, and we'll have more ahead the next hour. Welcome back to The China Show. We're taking a look at how the CSI 300 is going. Half an hour into the session, we've actually seen it reversing some earlier losses here, trading up nearly 1% higher. Something that you've got to say could be helping boost sentiment today is this headline or this scoop that we've actually just had at Bloomberg talking about this plan to slash home buying taxes. So this is, again, according to sources, it is our scoop, but it's part of a fiscal stimulus push from officials there. Try and shore up the property sector, try and get some interest in it.
Trying to stimulate people, buyers who have been just not wanting to catch a falling knife, right? With property prices continuing to go down, if you can remove some of this tax burden, perhaps they will go into it. So we're going to talk again in the opening moments of this half hour further with Min Min Lo about this story.
Yeah, that's right. We'll get into the details. But broadly, how markets are faring so far, well, we're taking a look at what's happening in the property space in particular, and we are just seeing those gains coming through. Sunak, for instance, up nearly 6%. But broadly, we are seeing most of these names here moving to the upside, even though when you actually take a look at the broader index, we've already perhaps seen it pairing some of those gains as well. So I guess perhaps the signals are being interpreted differently. But let's get more with our China correspondent, Min Min Lo. And Min Min, there's quite a few details to this in terms of the different taxes that are being applied, the different distinctions. But talk us through how the new regulations are being mapped out and proposed, possibly.
Yeah, so the government is working on a proposal to allow the mega cities like Shanghai and Beijing to cut these deed taxes from 3% to 1%. And on top of that, they are removing the distinctions between non-ordinary and ordinary homes. So non-ordinary homes are usually homes that are above a certain size. In Shanghai, it's above 144 square meters. And normally, on top of the deed tax, you need to pay a value-added tax of about up to 5% when you sell these non-ordinary homes within 2 years. So by scraping that distinction, that means it will basically lower the cost for home buyers who want to upgrade their homes. So again, it comes after the series of measures that we have seen over the past 2 months, including the lowering of down payment ratios, lowering existing mortgage rates, and the easing of home buying curbs in big cities to really support the property sector.
You know, I just came back from Shanghai.
Yes.
People are not that confident yet. Is this going to spur home buying?
Yeah, I think we really have to wait for the data because we did see a bit of a green shoot. If you look at October data, we saw a positive for home sales for the first time in something like 16 months. It was up some 7% compared to a 30-something over percent slump the previous month. But again, I think we have to wait for data this month to decide whether this is a sign of the sector bottoming out or not. Because remember, there are 60 over million unsold homes, and the relending facility by the PBOC, that 300 billion yuan, had seen a very low drawdown rate of only 5%. That's very low. That shows that there is a huge reluctance from local governments. Even with the funding available, they're not willing to use that funding to turn these excess houses into social housing just because rental yields are so low. So there's still a lot of problems to solve in the housing market.
Certainly are. I mean, that could be an understatement. That was our China correspondent, Min Min Lo there. Let's get more on the market reaction to this. Bring in Mary Nicola in Singapore, our Bloomberg M-Live strategist. And Mary, I mean, we're seeing the market reaction and we've seen the CSI 300 now moving into positive territory. At the same time, it's that question is how long does this last for exactly? Because you've got that better reading there. You've also had the credit data coming through, for instance, that underwhelmed. So what are investors going to be listening to most and for how long?
Yeah, I think this is all just like incremental positives rather than it's still we haven't gotten a broad-based solution. For example, as Min Min highlighted, you still don't have any sort of resolution on all the property overhang that's still there. There's so much supply out there. So so consumer confidence still hasn't really turned around. But these are just the incremental positives. But the market is tired of incremental solutions. They need something more broad-based. They need something that encompasses all the different structural issues.
So until we have more clarity on stimulus from China, does the Trump trade still have wings in this part of the world?
Yeah, probably, especially if the dollar continues to move the way it is. The dollar has been absolutely resilient. So irrespective of what's happening with the Trump trade, you still have some headwinds coming through, potentially with U.S. CPI, retail sales, could obviously set the stage of a skip in December if CPI comes in a little bit hotter, and then if retail sales shows that the U.S. economy is holding up quite well. So that just adds fuel to the dollar, and that's going to weigh on not only currencies but equity markets in the region.
What about the geopolitical risk as well, Mary? Because we were just had some reporting out, Bloomberg as well, saying that Trump is expected to choose Marco Rubio as the next Secretary of State. He's someone who's been very hawkish on not only China but also Iran in the past. Have we fully baked that in yet? Has it fully been factored in prices right now?
I think the concern on tariffs is going to be the biggest overhang for markets, and it's going to make sure that markets especially within emerging markets, really don't have their chance to shine. And of course, it has a large part to do with the fact that how does this unfold? How broad-based does it go? Does it go not only to China, but to the rest of the region? And of course, a lot of the countries in this region are very dependent on trade. So how growth unfolds can be a real issue for a lot of countries here, and then of course broader for emerging markets. So a trade war is not something that that investors want to see. It's not something that markets, especially across emerging markets, want to see.
All right, Bloomberg M-Live strategist Mary Nicola in Singapore. Thanks so much. Still ahead on the China show, we'll be at the UBS Australasia Conference, where Alcoa President and CEO Bill Oplinger joins us with his outlook on Chinese commodities demand. Keep it right here. This is Bloomberg and the China Show.
Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate when your comps get tougher. How much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Well, moving through the Asian trading session, and equities are under pressure for a second straight day. You can see there, it's really that story. Yes, you've got that China economic outlook really weighing on the picture here. You contrast that to what we're seeing in the US, because this is taking a look at some of the real Trump trades that are in focus. Yes, you've got that prospect of deregulation that's playing into banks in particular. Tesla, of course, we know Elon Musk, a key backer and also possible beneficiary. Bitcoin, but also really close watch on what's happening with the dollar, because we saw that dollar gauge hitting a year-to-date high overnight. And it could be that story that dollar strength persists, and it really plays into what we get out of the inflation figures later this week, whether it tells us that inflation is going to be sticky, that so-called last mile of bringing it back down. What does that mean for the Fed, and also the expectations around where the Fed goes with its cutting program over the course of the next year. But let's get more on that. Bring in Leon Goldfeld. He's Asia-Pacific Head of Multi-Asset Solutions at JPMorgan Asset Management. And Leon, what's your take on this? The dollar strength, of course, it has big ramifications for this part of the world as well, equities, FX. But let's just start off with where you see the dollar heading from here.
Look, our view is the dollar here is relatively underpinned, largely because fundamentally US growth is still very solid. And our expectation is that US continues to grow at trend, or maybe even a bit above trend, into 2025. And that takes a lot of rate cuts out of where the market was expecting. Inflation, you're right, is coming down. It's going to be a sort of maybe a net positive, but not a dramatic one. I think the key pivot point is that the market is reassessing what growth is likely to be next year, and therefore how much the Fed has to cut. If the Fed cuts less, and at the same time, if we do get tariffs, and I think this is still a negotiation, we'll see where that goes, but that puts pressure on Europe, puts pressure on Japan to offset that through easier monetary policy. So that difference in monetary policy is what's going to keep the dollar, in our view, relatively supported.
It's interesting. You've upgraded your growth assumptions for some EM economies, in particular Taiwan and Korea, on the back of perhaps AI investment. But we have to bring in the specter of Trump tariffs, and also, again, which contrasts a little bit with the weaker currencies if the dollar continues its king position.
Yeah, so we've actually just released our long-term capital market assumptions. So this is our view for the next 10 to 15 years. It's really our North Star when we set strategic allocations for our clients. In those assumptions, we have upgraded growth across the board, both for developed and emerging markets and AI, productivity, but also just the fact that there's just much healthier level of investment. Both government investment and corporate investment has uplifted those numbers. And so Korea, Taiwan are beneficiaries of that sort of stronger global growth over the next sort of decade or so. Now, that does support, we think, their economies. That does certainly support their corporate sectors. In terms of currency, though, I think that's a bit more of a trickier spot, because ultimately, if there is US exceptionalism, US dollar continues to get that get support, and if yen is weaker, the Korean won will follow it to some extent. So I think on the currency, it's maybe a little bit of a different game for emerging market currencies than it is, let's say, for equities or growth.
What about back to Steve's point around sort of that Trump risk, but what about protectionism as a whole, and how do you see that over a 10 to 15-year horizon then? Yeah, so one of the themes we highlight is nationalism. So protectionism sort of falls into that broader category. Now, a lot of focus has been on, is the world now deglobalizing? So that's, again, a side of nationalism. Our view is maybe a little bit more nuanced. What we think is that the level of globalization has basically plateaued. There's still globalization in services, but the level of globalization in goods has plateaued. But we still see huge economic rationale for companies to continue to use global supply chains. So yes, there's going to be some domestic insourcing to get themselves insurance if there are supply chain disruption. But we're not seeing a wholesale kind of change in the way the trade system is really working. So I think where the US administration is going is obviously to support their own domestic manufacturing, and they will achieve success in that, we think, because they have a lot of power to do that. But I think even with that intention, there's a lot of pressure on the Republican administration from businesses in the US who are global to continue to make sure that the US stays very connected in the global economy.
So where does, in your estimation, a long-term capital portfolio, the allocation in that portfolio, what does it look like? When we are constantly on the short attention span theater here in the news cycle, where everything is the potential of Trump tariffs, the potential of stimulus from China. So 10-year outlook, when the next 4 years are going to be dominated by Trump in every headline, how do you lay that out?
Yeah, that's a great question. So the way we consider it is as follows. Even though 10 years does seem like a very long-term horizon, actually that horizon is quite relevant whether you're an insurance company, whether you're an individual, because your own investments are much longer than 10 years in terms of your own investment horizon. So the way we think about it is that helps us to set the long-term goal, what we call the strategic goal. Around it, as environment changes, we tactically manage. And so, yes, we may be, for example, today, we think over the next 10 years, a 60-40, 60% global equities, 40% global bond portfolio can return something in the order of 6.4% over the next 10 years. 6.4 may not sound much, but compared to inflation, which is likely to be closer to 2, that's a huge premium. And compared to cash, which is likely to be 3, let's say Fed funds, over 10 years, that's more than 3.5% premium. So a broad equity bond portfolio is still the right place to start. But of course, you're going to make tactical changes as the world evolves.
How does China fit into that portfolio? Because in the near term, of course, the biggest risks still relate to consumption and also to the property sector. We just had a scoop out talking about possibly plans to slash home buying taxes. It's all about that fiscal stimulus push. Given we see this as a multi-year problem, if you're looking at a 10 to 15-year horizon, do you see that being worked out?
I think there is a huge rebalancing of the Chinese economy that the Chinese policymakers are undertaking. And it's a multi-year project because essentially they're moving their economy from one that was very capital intensive, driven by all the infrastructure, property, investment spending, towards something that is maybe going to be, in the longer term, more technology driven and more productive. What China is really about isn't necessarily the absolute level of growth, but it is about changing the mix of growth to give productivity a much bigger say in terms of what that growth rate will be. That rebalancing is very healthy, but it will take time because what China is basically having to reduce in size, like the property sector, infrastructure sector, are very big. What they're trying to grow is still relatively modest in size. So that rebalancing is, I agree, Annabelle, it's multi-year. But and it may be 3 years, 5 years, but at the end of this, China is going to be a much stronger, much more productive economy. So we do see long-term optimism on China, but it will take time, and markets don't give much time horizon. So we have this disconnect between market short-term view and I think China policy, which is long-term focused.
What about Japan then? Because it's benefited as a rotation of funds into other markets out of China earlier part of this year. Japan's stock market's done very well. The yen is weakening again to 154 thereabouts. That helps corporate Japan, but does the stock market still have legs?
We think Japan looks reasonable. Like in our sort of relative ranking, our preference is still US, where we have, I think, the most confidence about earnings growth, about delivery of growth, lack of, risk of recession being very low, at least on the next year and a half kind of forward-looking horizon. Japan, in our minds, is not as strong in terms of the earnings they're going to deliver, but Japan still looks pretty healthy. So we do see a positive outcome in Japan, but it's just maybe a little bit shy to what we're thinking about the US.
What about alternatives? Do they sort of have any sort of role to play in this? I mean, it has been a sort of a period of asset markdowns.
So one of the interesting things for us when we look at alternative valuations and also the prospects that alternatives have in our long-term assumptions is that when we look at real estate in particular, we think valuations in US and Europe have reached pretty reasonable levels. Now, valuations tend to overshoot on the upside and overshoot on the downside. So it's not that valuations have necessarily troughed, but they are now at a point where we can actually expect pretty decent returns from alternatives like real estate over the next 10 to 15 years, sort of north of 8%, so above even what we think for equity markets. So I think alternatives, in the way we're thinking, to the extent that obviously investors can afford the fact that they're illiquid, and that's the challenge, but if they can take the longer-term time horizon that you need with alternatives, they're going to be rewarded, we think.
Leon, thanks so much for coming in. We value your insights. Appreciate the time. Leon Goldfeld, Asia Pacific Head of Multi-Asset Solutions at JPMorgan Asset Management. Okay, plenty more ahead. This, of course, is the China Show, and this is Bloomberg.
Nouriel Roubini says that Donald Trump's return to the US presidency could see the re-emergence of so-called bond vigilantes if he follows through with his big spending plans. Bloomberg's The Asia Trade co-anchor Heidi Stroud-Watts spoke exclusively with the Roubini Macro Associates CEO at the UBS Australasia conference.
Certainly, the election of Trump is going to make big economic policy differences. The question, what's going to be the impact on growth and inflation? Some of his policies are going to keep the growth strong and keep inflation low. He's pro-business. He wants to deregulate the economy. The reduction of tax rates for the corporate sector is going to be good for private business confidence. And moving towards more production of fossil fuels is going to reduce maybe energy prices in the United States. Those sets of policy would imply good growth and inflation under control. On the other side, during the campaign, he said 10 to 20% tariffs on all imports in the U.S., up to 60% on those from China, trying maybe to weaken the value of the dollar, draconian restriction to migration, if not mass deportation, tax cuts that may be unfunded and increase the budget deficits, and potentially interfering even with the independence of the Fed. If they were to follow those latter types of stagflationary policies, inflation will be higher, growth will be lower, bond yields will be higher because there is more inflation and more real rates with unsustainable deficits. That's going to crowd out economic growth, and bond yields above 5% would imply a correction of stock prices and negative impacts on the economy. So the question is whether he's going to be more moderate or more radical in his policies.
And it's a combination that we need to sort of unpack, from fiscal to immigration to trade to geopolitics. But I wanted to start off with the fiscal. What sort of time frame would you be looking at in terms of the transmission to that, to potentially that stagflation, or at least, you know, pretty reflationary impact? And how does that play out for the Fed?
Well, it's clear he wants to make the tax cuts of 2017 permanent. Plus, he made other promises during the campaign would imply that you'll have another almost $8 trillion of debt or deficit over the next decade. If those things were to happen, I think the market discipline is going to be quite quick. Bond yields have been already going higher before Trump was elected on expectation of his election. They went even higher right after his election. They went slightly lower just because the Fed said, okay, we're going to cut rates and going to wait and see. But if a certain sets of policies, starting with the fiscal, are implemented and imply higher inflation and overheating of the economy, the Fed will have to cut less, maybe eventually stop sooner, and in a scenario in which actually other policies are stagflationary, leading to higher inflation, whether it's currency or tariff or migration restriction, then the Fed could even decide to raise rates, and then the Fed and Trump will be on a collision course. I would say, however, is that he cares about market discipline, and if bond yields go higher and the stock market correct, that's a bond vigilantes in the market saying your policies are unsustainable. And if he chooses the right economic advisors, they're going to warn him against policies that eventually have such a market impact and may lead to policies that are more moderate rather than radically populist in the first place.
And you have been critical of higher equity prices and what markets are doing at the moment, which is quite a great deal of exuberance, right? Do you worry when you take a look at what market participants are not pricing in, perhaps, in terms of the downside?
Well, the market has gone even higher after his election because his policies look like they are leading to greater growth, reflationary trades, and overall pro-business, pro-private sector, pro-M&A, lots of other things that are good for the private sector. I think that markets are still in wait-and-see mode to figure out whether the policies are going to be hurting the economy, whether it's tariff, currency, migration restriction, interfering with the Fed, having unsustainable budget deficits are going to be implemented. Maybe the markets believe that the market discipline is going to discipline him in advance, knowing that policies are not sustainable, are going to lead to bond market vigilantes and the stock market punishing him. So the market is optimistic that those things are going to restrain him ex ante as opposed to ex post. And that's why the markets are rallying.
And as Roubini Macro Associate CEO Nouriel Roubini speaking with Heidi. Here are some of the Big stories we are following. Sources say the European Union is seeing very limited progress in negotiations with China aimed at finding an alternative to tariffs on EVs. We're told China hasn't yet moved towards the EU's strict requirements on ensuring that any arrangement is enforceable and effective. Technical talks will continue this week, but our sources say the EU still sees little prospect of a quick deal. And Indonesia has denied recognizing China's disputed claims to the South China Sea. A joint statement during President Prabowo Subianto's Beijing trip said both countries would collaborate on maritime initiatives and develop areas with overlapping claims. But Jakarta's foreign ministry has clarified that the statement can't be interpreted as an acknowledgement of Beijing's controversial 9-line claim.
Final few minutes of trading here before Japan goes on the lunch break, and we're keeping an eye on the Japanese banks in particular. We saw Rakuten Bank, for instance, surging as much as 13%. It's boosted its net income forecast for the current fiscal year. As well, the three mega banks are seen reporting a combined net income of 2.4 trillion yen for the April-September period. That's according to the Nikkei. And quick check as well on what's happening with Renesas. Japan's Ishiba is pledging aid to that chip maker and the chip making sector overall.
Well, it's 11:29 a.m. in Tokyo. Japanese markets are about to head to a break in about a minute. And you can see the Nikkei 225 was up about 0.5%. In fact, it's been up, 1, 2, 3, 4, 5 out of the last 6 sessions. As we also see, if I can squint and see what that says there, the yen, 153.84, approaching 154, Annabelle.
Well, it is the flip side of that, of course, is what we're seeing in terms of the dollar, because we've seen the dollar gauge hitting a year-to-date high. That has certainly had ramifications across the commodities landscape. It's also reacting to concerns around weaker demand from China, because whilst the good headlines seem to sort of pile up for US assets, the negative ones in turn are really surrounding China's economy with, for instance, FDI, aggregate or credit data, for instance, inflation figures, the debt swap plan, even though we just had that property scoop out earlier, giving a bit of a boost perhaps to that corner of the market. But here's the state of play that we're seeing. Commodities are broadly under pressure. But let's get more on the outlook for these metals now. Return to our coverage of the UBS Australasia Conference in Sydney, where investors and business leaders have been gathering to discuss the global investment landscape. Our Asia Trade co-anchor Heidi Stroud-Watts is there for us. And Heidi, very big guest with you as well.
Yep.
Belle, certainly. Joining us exclusively here is Bill Oplinger, who's the president and CEO at Alcoa. Bill, really great to have you with us. And Belle was just kind of talking through some of the China side of the risks and uncertainties, right, in terms of how they manage that slowdown. Obviously, there's also a degree of uncertainty and challenges looking ahead to the US economy and global trade. Is there a bit of a holding pattern right now when it comes to the commodity side of the business?
I don't know that there's a holding pattern per se. The commodity side of the business has been pretty strong. Global aluminum demand is good. We've seen some real tightness in supply across the global system. So not a holding pattern, no.
So a degree of confidence. Do you expect that tightness to continue?
So when we look at the tightness, we're really in three markets, right? Bauxite, alumina, and aluminum. Bauxite's the underlying mineral that comes out of the ground, alumina is the intermediate product, and aluminum's the end product. In the aluminum market, we're seeing strength in demand in packaging, to some extent in transportation, and to a lesser extent around building construction. And we're also seeing supply side constraint coming out of China. They've capped their supply capacity at 45 million metric tons of aluminum. When we then go up the value chain, bauxite and alumina is very tight currently. There's been a series of supply disruptions around the world, and those are creating a tight supply market. Alumina prices are very high, bauxite prices are very high.
Alcoa is such an interesting business in terms of how it sits within the scope of US tariffs, right? Obviously, under the first Trump administration, some of those steel and aluminium tariffs really benefited Alcoa. Is that how you kind of the prism through which you view it this time around, or is it more of a balanced view because of the globalization of your assets?
So it's really important to remember that we have 27 sites around the world in 9 countries. We have 11 aluminum smelters, 2 of which are in the U.S. We have no mines, no refineries in the U.S. There's an existing tariff structure that it's in place. It's the 232 tariffs that the Trump administration put on back in the first Trump administration. If there's any further tariffs, we'll obviously work within that tariff structure to determine the impact on the company.
Broader tariffs on China, though, does that make you worry about global trade and the momentum?
We see tariffs ultimately as being disruptive of market forces. However, the world is going towards less of a free market environment, so we'll manage within the tariff structures that's put in place.
One of the other sort of uncertainties and potential disruptions is to do with climate, right? And there's sort of ongoing litigation and some of those concerns, particularly in WA. Is that a risk when it comes to the Australian market and some of your ambitions here?
We've had some permitting issues over the last couple of years in Western Australia. We've managed through those permitting issues. We see Western Australia and Australia in general as a pretty good place to do business in. When you put it in perspective of where we are in Australia, we've got 3 refineries, 2 mines, 1 smelter in Australia. About 25% of our ownership base is in Australia, so we see it as a pretty favorable place to do business.
Is climate risk more broadly and some of the activism that we've seen, is that a growing challenge for your company? Does it also sort of sit uncomfortably with really kind of the future-facing role of alumina?
So I actually see it as an opportunity. So as we transition to a new energy economy, aluminum's critically important in that economy. Aluminum's used in just about everything you see and touch, whether it's building construction, transportation. So as we drive towards a lower carbon world, aluminum is a big part of that solution. It's going to drive lightweighting in EVs. It's better for packaging. So overall, I see it as a positive.
For the bauxite market in particular, what do you think the biggest challenges are and the risks going forward?
Bauxite market is heavily dependent on Guinea currently. Almost a quarter of the world's bauxite is created in Guinea. They supply into China, so those supply lines are long into China. And so the bauxite market has become pretty short with some reductions of bauxite coming out of Guinea. So that has tightened up the bauxite market. It's driven prices to over $110 a ton of bauxite. And that is being reflected in much higher alumina prices also.
We've also seen disruption from Brazil. Do you have an update on that?
Yeah, we do. In Brazil, there was a ship that was caught in the channel. It's not our ship. It's a ship that was coming out of being loaded from one of our mines. That has we declared force majeure. That has subsequently been fixed. That ship is now out of the channel. Force majeure hasn't yet been lifted because we don't know the impact, but that situation has been remedied.
And there's bauxite assets that you're eyeing in Australia as well, right? Can you tell us more about the specific mines and I guess more of the time frame for approval?
So we're moving our mine site from its current location to a new location that should occur no earlier than 2027. We're going through an approval process that has public comment period starting in the first quarter of next year. That public comment period will last about 10 weeks. We expect the permits to be approved in early 2026. So that's on target to be able to deliver bauxite no earlier than 2027.
You don't foresee complications on that? Legal complications at all, for example?
We've really worked successfully over the last year with local government, federal government, to manage the permitting issues. And so at this point, we don't see complications.
And you've recently just closed out the alumina acquisition. What's your kind of thesis at the moment when it comes to inorganic growth? Are you always keeping an eye out? Is there sort of something that you're actively pursuing?
So we did just close the Alumina Limited transaction August 1st. We closed the deal. It was accretive in the first quarter. So in the third quarter this year, it was already accretive. We're anticipating that it'll be accretive in the fourth quarter. We're very pleased with that transaction because it's allowed us to do other transactions strategically. We just did a transaction in Saudi Arabia where we're trading out a minority partnership for ownership in the parent company. So we're very happy with that transaction. As I look broader, we'll always keep an eye out for inorganic opportunities. There's organic growth opportunities across our business in mining, refining, and smelting. So we're looking to build those out, but inorganic opportunities will be a part of our growth strategy also.
What is the broader growth strategy in terms of how much are you or are you not looking at diversification across other metals and minerals?
We are not looking at diversification. So we're focused on the vertically integrated upstream aluminum market. Bauxite, alumina, and aluminum. We think there's tremendous growth opportunities there, and there's still opportunities for us to improve our portfolio by driving our cost structure down, running our operations better, more safely. So no, we're not looking at diversification beyond aluminum.
We've talked a little bit about how so many of your assets are spread out globally, right? Is that a sort of a place of leverage and a place of advantage at a time of geopolitical and domestic political risk? We've seen some of the issues with Resolute Mining in Mali this week.
I think it's a strategic advantage. So if you look at from, again, mining up to aluminum, we have mines in Australia, Africa, and Brazil. We've got refineries in Australia, Spain, and Brazil, and we've got smelters around the world. So that geographic diversification is an advantage that really is unmatched in the aluminum industry.
Bauxite is quite interesting in the sense that you can't easily, relocate supply and have it refined elsewhere, right? Do you think that adds an additional risk in terms of the potential upside for prices and the downside for supply?
It's important to remember that bauxite is not only is it in a specific locale, so for instance, largely in Guinea, in West Africa, and Western Australia, but different bauxite grades are catered to different types of refineries. So it's not easy necessarily to change out bauxite grades between one bauxite to another in a refinery. So a refinery, and it's a little known fact about our industry, refineries are generally built for a specific bauxite grade. So as you see some of this shortness in the bauxite market, that just exacerbates the higher alumina prices.
Well, really great to have you with us. We appreciate your time.
Thank you.
Steve, I'm going to hand it back to you from the UBS Australasia Conference, day 2.
All right, very comprehensive conversation, Heidi. That was, of course, Heidi there with the Alcoa president. If you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests. Be kind, of course, during our live shows. Check it out at TV Go. This is Bloomberg. And welcome back to the China Show. Bloomberg has learned that President-elect Donald Trump is expected to name Marco Rubio as U.S. Secretary of State. Trump has been narrowing the field of candidates for other major appointments, such as Treasury Secretary, which could be announced this week. Our news editor, Jill Desis, rejoins us now. So what have you learned more about this that started off as a New York Times story? We have corroborated it. What do we know about Marco Rubio being the Secretary of State? He's been very anti-China, if you want to put it that way.
Yes, I'd say that, Marco Rubio, first of all, went from, one of the biggest, anti-Trump when he was running against him in 2016 for the Republican nomination, really kind of hit Trump quite a bit during the debates then, to over the last several years has become a real true Trump loyalist here, was one of his biggest campaigners this year. And yes, I think when you look at foreign policy in particular, Rubio has been a pretty enormous China hawk over the last several years. He was actually sanctioned by Beijing over a couple of different matters, whether that be a lot of, he was outspoken about the Hong Kong protests back in 2019. He also was very outspoken about the Xinjiang region in China and sort of a lot of the U.S. allegations facing Beijing there. So, I mean, this is somebody that definitely China, I think, has, sort of bristled against quite a bit. You'd imagine that if this actually does go through and that Trump ultimately, nominates, Rubio for this type of position, that he would continue to hold some of those really hawkish positions here.
It's not just China, of course, even though that's a primary focus for us, but there's a lot of question marks over the U.S. foreign policy in general and the direction that it's going to take in terms of commitment to NATO, for instance, what's happening in the Middle East. How does this sort of shape up for other areas in the world?
Yeah, well, really, I think, Marco Rubio over the last year or so has tracked Trump on quite a few different policies when it comes to foreign policy in particular. So he's very supportive of Israel's position in Gaza. That really kind of tracks with what we've heard from Trump over the last several months. Also, when you look at Ukraine, Rubio has really been on the side of Trump there in terms of, maybe, stopping some of that military support for Ukraine in Russia's war in Ukraine. You're seeing that a bit, out of Marco Rubio. He's also sort of tracked some of those Trump policy positions on acknowledging that maybe there would have to be some concessions to Russia in, an end to the war in Ukraine. So I think at this point, I mean, again, if this appointment actually does go forward, you'd likely see a lot of those things sort of track with what Trump has already said. I mean, again, Marco Rubio really is just, has been a really, really big loyalist, really sort of parroting a lot of those Trump positions on foreign policy and other matters over the last several months.
All right, that's our Bloomberg News Desk editor, Jill Deesis there. And, of course, it's not just foreign policy. There's climate policies in focus as well. And speaking of those, climate negotiators have secured a breakthrough on day one of the COP29 climate summit. They agreed on rules for a UN-administered global carbon market, which aims to unlock billions in finance for developing countries. However, some climate groups say the rules still have significant issues and criticise what they called a backdoor deal. Galaxy Entertainment founder Liu Che-Wu has died at the age of 95. A company statement says he passed away on November 7, leaving behind a $14.5 billion fortune. Liu won a gaming license in Macau in 2002 as the government ended a 40-year monopoly that had been held by the late Stanley Ho. He built an empire in what became the world's biggest gambling hub, competing with the likes of Steve Wynn and Sheldon Adelson. We'll have more ahead. This is Bloomberg.
And welcome back to the China Show here on Bloomberg. Of course, a top story that we've been following all morning is this Bloomberg scoop, according to sources, that China plans to slash home buying taxes in another step-by-step fiscal stimulus push. Obviously, the market has been looking for a big bazooka. China is choosing otherwise to do a step-by-step approach. The market is somewhat muted on it. As you can see, the China Developers Index is into the red, down, as well as the Hang Seng Property Index, but some select developers are also heading higher. The story is China is planning to cut taxes for home purchases as they do dial up that fiscal stimulus. They're working on a proposal that would allow megacities, of course, being the likes of Shanghai and Beijing, to cut the deed tax for buyers to as low as 1% from the current rate of as much as 3%. Also, this is something that was hinted by the finance minister, I believe, last Friday. Essentially, they're also looking at giving the municipalities the ability to change the designation of non-ordinary and ordinary homes. Right now, non-ordinary homes are luxury homes, which also have an added value-added tax of upwards of 5.6%. So if they are able to relax that, that could potentially stimulate buying in a very beleaguered market.
Well, it's very interesting, that market reaction. As you say, we did have that sort of knee-jerk reaction perhaps at the start, and we saw everything sort of shifting high, but you've just seen some of those stocks there already trading back into negative territory. It is that question around how much of that fiscal stimulus push can actually try and help China achieve its economic goals. And again, that's something coming across in the state media this morning, because they're sounding pretty optimistic about the economy despite all of the weakness that we've had in the recent data. So taking a quick look at some of the front page reporting, the People's Daily, for instance, they're saying that there's growing confidence that China can achieve its target of 5% GDP expansion. Again, all down to these stimulus measures, even though we haven't really seen them taking hold in things like the inflation figures, for instance.
Yeah.
Analysts are saying that the growth rate is likely to pick up toward the end of the year as these policies start to take effect. The paper as well saying that growth momentum is strengthening due to investments in high-tech industries. As well, we've got the PBOC-backed financial news, and they're saying that the central bank should inject long-term liquidity in the fourth quarter to offset an expected spike in government bond issuance. It's, of course, another big talking point as well. That's as the governor, Pan, pledges to continue adopting a supportive policy stance. So experts as well speaking to that paper, and they're saying that China has room to step up monetary support as other countries embark on an easing cycle. But, of course, that's the big question we keep hearing about. Yes, we've got this fiscal firepower. Yes, we can do more. Is it going to be that too little, too late, not enough kind of situation?
Yes, more action, fewer action plans, right? They want to see the fulfillment of these pledges, obviously. Meanwhile, a nighttime biking craze has sparked a backlash from Chinese officials concerned about university students gathering in large numbers. For more on that, let's bring in our nighttime biking correspondent, Min Lo. What is this story?
Yeah, so over the weekend, there were thousands of these students gathering on the streets. They flooded this 6-lane highway in central China in Henan province. They were cycling from the provincial capital. Take a look at that very dramatic footage. Yeah, so basically flooding the highways. The police were there. Look at all those bikes. The poor cars stuck between the bikers. So they were going from the provincial capital in Zhengzhou to this ancient city called Kaifeng. And what happened was basically authorities were upset, and they started sending out notices reminding the cyclists to be aware of the traffic rules. And some universities, according to local media, had told students to apply for exit permits to leave campuses. And some of these bike-sharing apps as well, they started warning that they're going to remotely freeze these bicycles if they go out of Zhengzhou city.
How did this all start? Look, I lived in China in 1990. And it was nothing but bicycles. It was a bicycle kingdom, really, up in the Dongbei when I lived there in Shenyang. So how did this rejuvenation of the bicycle happen, and why are authorities...
It's extremely random. So 4 female friends did this night cycling ride. It's like over 5 hours. They wanted to get to Kaifeng city to have a nice juicy guantang bao, which is the soupy buns. And then that went viral on social media, and everybody wanted to replicate that experience and end up with like a nice hearty breakfast at dawn. And then it just kind of blew up into this big trend, and I think the local government supported it because they said it helped, breathe life into tourism. So they started organizing volunteers, docking stations for these bicycles, for example, and that earned some appreciation from students. But now I guess it's overblown because it's like a night party on the streets, and some people were carrying flags and they were chanting slogans like "Long live the party," and I guess that was just too much for the authorities.
I mean, those images are pretty exceptional, just thousands of people. And now we've seen sort of the crackdown as well, as you were saying, from officials there that are sort of concerned. But I guess it's that question mark around what's behind this crackdown and why is it coming? Is it really about safety? Is there something more behind it?
And what's the public saying about it?
Yeah, well, I think students gathering in large number is always something the authorities is quite uncomfortable with, because traditionally we have seen how university students have been able to start protests in the past. And so on social media, there are people who are just kind of, kicking up a furor over this, like, why is the university sealing the campuses? Here's someone saying, okay, you can go cycling in 3s or 5s as long as you don't create a problem, you can do whatever you want.
Who's saying this?
This is people, just random users on social media. I just plucked out some of the comments there. Another one is saying, I'm watching this and I really want to laugh at them, but I also want to scold them as well. I mean,
Sounds like a mom.
Yeah, I was going to say that.
Yeah, and someone else also said something interesting, like why are all these people blindly following the trend? It's because they don't have a job, they don't have hope. If everybody has a goal and some hope, then they would have something better to do instead of blindly following this trend. So pretty mixed response.
That might be the reason why they're cracking down on it right there. Go get a job. Stop riding your bike.
All right, that was our cycling correspondent, as you would say, Min Min Lo, but actually Min Min's, of course, been tracking that other big story for us this morning, and that's certainly what's happening in the property sector, given the biggest story perhaps in China today is this plan to slash home buying taxes and yet another fiscal stimulus push. And we are just continuing to keep an eye. We're actually seeing the developers index slightly in the red, but there are those select names that are continuing to push higher here. So that is the state of play. China show done for another day, but Insight with Haslinda Amin is next.
It's a bumpy ride.